I'm delighted to be here at the AJ Bell Investival 2020 to talk about the Lion Trust Global Smaller Companies Fund. I believe this fund can both diversify investors' portfolios and very substantially increase the returns for long-term investors. It's now the largest holding in my own pension fund and ISAs at over 40%. On slide 1, we can see one of the best kept investment secrets, that smaller companies outperform larger companies consistently over the medium and long term. On the left-hand side, we can see a chart of cumulative performance since 2001 of the MSCI small cap index against the MSCI large cap index. The small cap index is in green, the large cap in gold. The small cap index is up just over 375% over this time period, against a rise of just over 200% for large cap. That's 87.5% more for small cap. A massive difference. And that's just the index difference. An active manager can add even more value and return over and above the index. On the right-hand side of the slide, we can see that since 1994, which is the start date of the World Small Cap Index, that small caps have consistently outperformed large caps. And the longer you hold them for, the greater the probability of outperformance. So in all one-year time periods, global small caps have outperformed global large caps 56% of the time. Critically, that figure rises for the outperformance over 3 years of small cap to 66% for all 3-year time periods, 2/3 of the time. And it's 76% in all 5-year time periods, over 3/4. And then amazingly, 94% for all 10-year time periods. An extraordinary set of figures. And I think it's one of, if not the best, investment kept secret in investment. So global small caps have consistently outperformed global large caps since 1994, and the longer you hold them for, the better the outcome. Now, slide 2 is, I believe, a very compelling slide showing why right now, in November 2020, there's a really attractive entry point for buying global small caps. They are, as you can see on the chart, enduring one of their longest and most pronounced periods of underperformance relative to large caps since the 1990s. Even despite this, the Lion Trust Global Smaller Companies Fund has performed very strongly during this period against both the small cap index, the large cap index, and in absolute terms. But small caps globally have suffered from risk aversion, COVID-19 perceptions, trade war focus, Brexit focus. Globally, investors are bought into mega caps, with the result that the top 5 and top 10 stocks in the MSCI World Index, the top 5 and top 10, are a much greater part of the index than they've been for a very long time. The top 10 stocks in the mega caps account for nearly 20% of the whole of the MSCI large cap index. And this has driven down the weighting to small caps, held by both passive and active investors. In 2003, small caps were over 13% of the IA global sector. Now they're below 5% and falling. So I do think that now is a good time to buy global smaller companies. Let's move on to slide 3. In 2020, as we've seen, the global small cap index continues to underperform large caps. But as we can see, this underperformance is most pronounced by a very long way in the USA. The fund currently has 74% invested in the USA. But if we can see here, 15% is the margin by which US small caps have underperformed US large caps. Now, everyone's aware that Fangs, the high-quality, innovative technology companies that have thrived during lockdown conditions with demands for their products and services increasing dramatically for both consumers and businesses as they've adapted to lockdown. But what people have failed to realize is that underneath this new technology and innovation and social change, there's the next generation of Fangs reaching up to take their place in the world. And those stocks in the Global Smaller Companies Fund are looking to future-proof your portfolio as we go forward. This current level of underperformance by global smaller companies makes me very excited, as global smaller companies have a history of outperforming during periods of recovery in the market, like in 2009 going to 2010 after the global financial crisis, and also in 2002 and 2003. I believe there's a treasure trove of exciting smaller companies out there. On to slide 4. Despite the underperformance of the small cap index, the fund, as we can see here, has considerably outperformed. It's an active manager's paradise to have such a wealth of investment opportunities, providing that you have a disciplined and repeatable process. Let's put some numbers on it. Since launch, the Lion Trust Global Smaller Companies Fund is up 123.05%, compared to 66.25% from the MSCI Large Cap Index and just 48.57% from the Global Small Cap Index. Two of the most widely held and admired global equity funds in the UK that are Large Cap, Fundsmith and Lindsell Train Global Equities. There is absolutely no overlap between our Global Smaller Companies Fund and those large cap funds, or indeed any other large cap global funds. So we're entirely complementary to these top performing large cap global equity funds. And I believe this fund offers genuine diversification. And as we can see, this is an asset class which active managers can really thrive in. The fund has an active share of over 98% against its benchmark. As you can see, I'm really excited about this. Now, on to slide 5. The Lion Trust Global Smaller Companies Fund invests in high-quality growth stocks to future-proof your portfolio using the 5 key drivers of technology, IP, science, social change, and entrepreneurial vision. This process has taken me 15 years to develop. The fund has a clear investment philosophy. We're looking for smaller companies that are capable of exponential growth, buying them at no smaller than £2 billion and holding them until they reach £10 billion. They're sold on reaching £10 billion unless we think they can reach 50 or 100 billion or beyond, in which case we'll keep a smaller proportion of them. And this part of the portfolio is never allowed to be more than 18% to obey all the rules of a global smaller companies fund, but typically this part of the portfolio is about 12 to 15% of the fund. But bear in mind that Twilio now has a market cap of over $46 billion and a share price of $292 on Friday. And yet 3 years ago, just 3 years ago, its share price was only $24. It's a more than 10-bagger in just over 3 years. We believe that this 2 to 10 billion part of an exponential company's growth is the lowest risk part of the valuation cycle. A £2 billion company has significant history, structure, management and liquidity for me to feel confident in investing. Liquidity, liquidity, liquidity are the key for global smaller companies funds to ensure that they're scalable and repeatable. So let's look at it. A 2% holding in a £2 billion company for a £2 billion fund is only 2% of that company. And so this fund has ample liquidity to be scalable and repeatable. Now, the Lion Trust Global Smaller Companies Fund has a 7-factor investment process to try to select the very best of the very best. This took me 15 years to develop, but it was worth it. First, intellectual property. A company must be built on intellectual property, usually outstanding science or technology, to future-proof it and make it capable of exponential growth. Secondly, management. Management must be entirely focused on the business and very heavily incentivized by substantial and material ownership of the company to ensure they become very well rewarded, aligning them with outside shareholders like ourselves. We want them to be multimillionaires, preferably eventually billionaires, if they grow the company from 2 billion to 10 billion and beyond. Secondly, addressable market. We look very carefully at the TAM, or total addressable market, of a company that we're looking to invest in to ensure that it's focused on a large, growing and profitable part of the market. Fourthly, growth runway. We like to see a company that has the ability to grow very fast in fast-growing markets, that is capable of broadening its offering as it grows. Fifth, barriers to entry. We like to see a company that uses its IP and quality management to build a moat around the company. They must be capable of fending off larger or mega cap rivals by demonstrating the superiority of their own goods and services, and remain independent for as long as possible to realise full value for shareholders. 6, importantly, risks. We work hard doing a 360-degree walk around companies that we are potentially looking at putting into the fund, to be aware of all the risks facing that company, so that if these risks materially threaten our returns, we can sell before the company's well-being is threatened. These risks might be internal, like the loss of key personnel, or external, like legislation or heightened ESG risks. Lastly, but very importantly, valuation. Even though these are fast-growing companies in fast-growing areas, we have to test valuation meticulously, e.g. by looking at a company's TAM and ensuring that valuation reflects the true prospects of the company's business and not the seductive noise and hype of the stock market. Now remember, on the 16th of May 1997, you could have bought Amazon stock at $1.73. Now, last Friday, it traded at nearly $3,300, a gain of over 190,000%. So let's find the next Amazon, the next Fangs. On to the next slide, the last one, slide 6. I'll show you what we do with our winners. I think that's important. We've already discussed that we keep smaller holdings and just our very best stocks if we believe they can reach 50 or 100 billion. But as stocks reach and then surpass 10 billion, then they're re-evaluated, and the best opportunities migrate into the Global Alpha Fund. And no fewer than 15 of the 50 stocks in the Global Alpha Fund started off in the Global Smaller Companies Fund. And some of the Global Alpha Fund's top performing stocks this year, like Twilio, up over 200%, and Ringcentral, came from the Global Smaller Companies Fund. The Global Alpha Fund invests in high-quality growth stocks to future-proof your portfolio, using the 5 key drivers of technology, IP, science, social change and entrepreneurial vision, with a bias towards mid-caps. It has a median market cap of just over 20 billion and also holds some select mega-caps like Microsoft, Alphabet, Amazon. I love this fund to bits too, and have over 40% of my pension and ISAs invested in it, just like the Global Smaller Companies. Since launch in 2001, the Global Alpha Fund, with its technology, IP, science, social change and entrepreneurial vision, and its bias towards small caps, has grown by 733.9%, compared to just 284.6% from the MSCI World Index, outperformance of over 257%.
The Fangs have performed strongly in 2020, with Amazon up over 80% and Apple up over 60%. How does the performance of small cap tech companies compare?
Yeah, that's a really good question. Well, actually, to be quite frank, 80%, 60%, great result, but they wouldn't even get in the medals table for the small tech global companies. 7 of my stocks this year are up over 100%, and one of them is up over 200%. So yeah, great performance from Amazon and Apple, but they wouldn't even make the quarterfinals.
How do you evaluate if small cap tech companies will be the next Fangs?
Yeah, another really good question. Well, I think what's absolutely critical here is management. It's unimaginable to think about Microsoft without Bill Gates, Amazon without Jeff Bezos, Alphabet without Sergey Brin, Facebook without Mark Zuckerberg. So management's absolutely critical, and I have a series of 7 tests I do on management. And these guys, I want them totally focused on the business. I want them driven. I want to be able to look in their eyes and see entrepreneurial vision blazing out. And I've got holdings of just companies of 5 billion market cap, where the founder is still there driving the business, and he's already a billionaire. So just imagine what those companies can achieve. So yes, that key component for the next Fangs, you've got to find management that'll get you there.
Can you give an example of a small cap tech stock that you like?
Yeah, I can do even better than that. I'm going to give you 2 examples. I really like Rapid7. It's a 3.5 billion company, tech company. It's into next generation security solutions. So it'll give you really a vision all the way through security. It can go all the way through to event management, and it can give both physical and online security services to all levels of business. Really excited about that. Another one I'm really excited about, which is 4.12 billion, is a company called SailPoint. Really like this. This is about identity software management to ensure that when people log in, they are who they say they are. It has still got its original co-founder in place, driving it along as the CEO, and it's just come up with some very good results. It's a very well managed company. Love both of them.
And a small cap stock you like that's not a technology company?
Sure, definitely. I can do better than that. I'm going to give you 2. First of all, a company called Trex, or Trex Decking as it's often known. It's a major manufacturer of wood alternative decking and other household, other outdoor equipment for people building out their outdoors. And it's benefited hugely from recycling. It deals entirely in recycled materials. It's the largest user of recycled plastic bags in the US. And unusually, it gets distribution from both Walmart and Lowe's. So distribution critical for a company like that. Again, very much not tech. And another company I'd like to highlight that's not tech is Horizon Therapeutics, an extraordinary drug company with a wide variety of drugs, both in existence to treat areas like gout and a whole load of rare diseases, eye diseases, inflammation, and an incredibly good pipeline again of further drugs to treat rare diseases, eye drops, thyroid treatment. Great company, love it.
Can you talk about a stock that's grown and moved from the Global Smaller Companies Fund to the Global Alpha Fund?
Delighted. And again, I'm going to give you 2 examples of that. The first would be Zendesk, which provides customer solutions to inquiries. So if you have an issue with an online company and you want to phone up and speak to somebody, very likely that it's a Zendesk who you will be speaking to through their customer support services. And if we imagine how things have grown during lockdown, the number of people phoning up, they're not the cheapest people in the market, but everybody I know who's started up small tech companies always uses Zendesk because they're very high quality and you don't want to upset your customers when they're phoning you up. Secondly, I'm going to give you Ringcentral, which is a cloud communication provider which basically unifies communications onto a single app so that you can speak through it, so that you can send texts through it. So, and as you can imagine, demand has accelerated enormously during lockdown for cloud communications. So Ringcentral, real winner.
Have you seen signs of small caps reversing the underperformance against large caps?
That's a great question. I so hope you're going to ask me that one. I have, and that's fantastic. And I'll tell you where I've seen it. First of all, I saw one of my companies, Infi, bid for about 10 days ago, Massively excited about that. It operates within the semiconductor space. So you've got large and mega cap looking down. Stock went up 30% in a day. Fantastic. But even more importantly, and this is where I think it's really coming from, as these companies in the fund have reported this quarter, they've moved up in the good ones, or the ones that have reported great results, have moved up enormously. 7, 8, 9, 10%, 12%, 15%. I've even had a company go up 20% on results. And I think people are increasingly looking down the market cap scale. And when these companies deliver knockout results, they're capable of going up 20% just on results alone. So yeah, I'm insanely excited. This is a really exciting time to be running a global smaller companies fund.